So we can now look at investing in bonds. We have stocks, we have bonds. Many investors consider bonds to be somewhat of a safe haven. They're generally corporate bonds we'll look at. We'll also look at government bonds as well. Again, corporations look at ways to finance their operations. We can issue stock, we can take out loans. We can also issue loans ourselves, and those are corporate bonds. So it's a pledge to basically say for a specific amount of money, generally in $1,000 and $10,000 denominations, that we will pay you back in said number of years. Okay? And again, now the corporation must pay this money back. But of course, the bondholder, unlike in stock equity, they get no ownership of the company whatsoever. So, for instance, this was a 6.85% bond in 1978. Great, due December 1st. So it was probably issued back in, looks like possibly 1969. And so you got 7% per year on a $10,000 note. That was a really, really good bond at the time. And again, there's our face holder of the bond. So, corporate bonds, again, the bondholder, what they receive is interest payments, again, usually twice a year at the said interest rate. These are legal conditions, of course, in the bond indenture. It is a little complicated for the corporation. And a trustee basically issues the bond as the corporation's or bondholder's representative. But again, there's your certificate, there's your dates, and usually very, very large corporations. This is $120,000, and so at the interest rate stated, that is, wow, that was 9%, my friends, 9%. That doubles every 8 years, so you can see where bonds in the past were really good, stable investments. Your main investors in corporate and municipal and government bonds tend to be insurance companies, mortgage companies, companies that issue long-term debt. They want a long-term investment to match that with. And of course, again, if you are in different areas of your life, if we are nearer retirement, let's say we're in our 70s, maybe our parents or grandparents in 80s, usually bonds provide more stability, that nice interest income, because we're looking at preservation, just preserving our wealth. Again, why corporations will sell them? Hey, we can finance our projects, finance our operations. But unlike equity, there's no ownership involved, and that's great. Sometimes it may be difficult or impossible to sell stock. Those are just some of the possibilities. And of course, some of the reasons we always borrow money is to improve our financial leverage. OPM, other people's money. Some corporations can certainly finance their own operations without a problem, but when you're nice and strong, it's nice to be able to use other people's money, especially in today's world, because the interest rates are quite low. And of course, for the corporation, there's tax deductible business expenses there too. So there's a lot of varieties for companies to issue bonds, and also they can certainly be a part of our portfolio. Again, as we get into it, debenture bonds are most corporate bonds. They are unsecured, which means if the corporation went bankrupt, okay, if we were holding on to Sears bonds for some reason, they have not matured, and let's say it goes into bankruptcy, well, the first people who get paid back are generally bank loans. And then you go into your types of bonds, and there's different series of bonds. And then it's preferred stock, then common stock. Well, what if there was nothing left at all? Even the bankers didn't get all their money. Well, then you lost your investment. Okay, there's no guarantee that you'll get paid back if the company is insolvent and goes bankrupt. Okay, so the mortgage bond is basically secured by different assets of the firm. Usually they're real estate, so you get a little better, less risk of, even if everything went bad, there would still be assets that backed that bond. So, other types of bonds, that you might want to look at. You look at convertible bonds, and these are special type of corporate bonds. Again, the bond market was so hot in the 1970s and the 80s and early 90s, but since interest rates are so low, it's difficult to get a lot of private investors, unless you're just extraordinarily wealthy, jumped into this. But you could get a bond that would basically convert into common stock. Okay, you could exchange that, so you could get the interest for a while, and then if you wanted to, you had the option to convert that, and basically it was a specified number of shares. And so if it was a $10,000 bond, you may have got basically 1,000 shares of stock. And so if the stock price went way up, you still got that 1,000 shares. You didn't pay the market price. So those were very, very popular items during those decades. Now, there's something called creative financing. Creative financing is another word for junk, and they're called junk bonds. Basically, these are underwriters who understand the risk. They certainly can go into developing countries. They can go into very young startup companies, and they pay a higher rate of risk. But we're very well versed with risk and return. So if there's a high rate of return, you can imagine there's a very high risk. And so they're basically graded as a C grade of bonds, which means the risk of it going bad is pretty good. 30% risk of it going bad. Okay, your AAA bonds, there's almost very little, like 1% risk at the most that it would not pay back. But hey, some of these junk bonds were paying between 15 and 20%, and so you could leverage with a bond ladder. That way, you could literally have different series of bonds and different risk levels to get a pretty good rate of return. We'll look at that here in a minute. Repayment, corporations usually on a bond, they can call it in or buy back from current bondholders before the maturity date. Well, why would they do that? Well, let's say that the interest rates that they put out were at 5%. They were paying you 5%, and then the market interest rate started dropping down to 2 or 3%. Wow, maybe even 1%, and we saw this happening throughout this millennia. The interest rates have been extraordinarily low. So you're now the CEO of that corporation. You're saying, let's call in our bonds, pay them back immediately, so we don't pay any more interest back, and then we'll reissue bonds at 1%, so we can take advantage of lower interest rates. Okay. Usually they won't do that for the first 5 or 10 years, but again, hey, there's nothing usual in our economy, so everyone looks out for themselves. And again, bonds, what we just talked about, are called if interest rates are higher than the general economy. So that's why you would have the call feature. How do we repay these things? Well, again, corporations can issue more bonds, if they had to issue more debt to pay for their existing debt. Generally, that does not happen. Generally, we do a sinking fund, and that's something that, it's kind of like our emergency fund, that basically we know when these bonds are due. We know that hopefully the operations for our organization is doing well, and so we'll put in an amount in other investments that will match the due date of those bonds, and so we sink that money into it. So when they come due, we can pay them all off. And of course, serial bonds are of a single issue that mature on different dates, and generally that's what happens. So we don't all have them due at one time. That's something that we would never want as well. We don't want all of our debts due on the same day, and especially long-term debt like that. So again, that's how we repay it. The psychology is this. It's asset allocation. We probably don't want, now that I've got you psyched up on stocks, and you're going to buy Apple stock like crazy, or Amazon, or all tech stock. If we bought all tech stocks, let's just say we did, do we have any asset allocation diversification there? We want diversity in our investments, and bonds provide that. They're hedges against things that go very bad, okay, because generally they're considered a safer investment, especially when it comes to government bonds, because the government can always just keep printing money. And so there we go. We want to start diversity of our investments. We don't want everything, the old adage, do you want all those eggs in one basket? Because if that basket drops, we could be in some trouble. And again, sometimes the bonds, will pay better than if I just put it in a bank account. They should. And so you have those options. So again, where we are in our investment stage, bonds are never a bad idea. That could be a great idea when we're just trying to conserve and preserve our money. For those who are just starting the game here of our personal finances, when I say game, we're in our 20s, we're getting our degree, we're about to go through what Frank is going through. Frank is our case study. Then bonds are probably way on the back burner. We want something more aggressive. But again, as we reach different decades in life, we start looking at much more diversification. Big investors love it because there are interest income every 6 months. So again, certainly your huge investors like insurance companies and real estate companies as well. They're great investments for that. And again, maybe granddad and grandmother like it too. So as we look, the interest is mailed directly to the bondholder, or or now it's probably paid in direct depositing. And of course, generally speaking, if you were to go to a bank, you have a registration coupon, and so pays the interest are paid to the coupon. Interest checks are, so they may require proof of ownership. Now, there's one bond out there that does not require proof of ownership. It's called a bearer bond. If you remember, or it's coming up on a Christmas season, and you watch the movie Die Hard with Bruce Willis, arguably his best movie, they're raiding Nakatomi Tower, but what were they stealing? They were stealing $750 million worth of bearer bonds. Bearer bonds is basically cash. There is no proof of ownership. All you have, the bearer, which means you show the bond at a bank, and they, well, at banks that will honor it. And those are your big investment banks. I don't think the one down the street does it, but your big, Wall Street banks, you show that to them, or London banks and French banks, they have to pay. You don't have to show your ID. You don't show anything. It's basically cash. So that's why they were stealing that. I think you'll see that in a lot of the older movies, and even a few, not so old, even this millennium movies. They're always said we get the bearer bonds because that's it. They're basically cash, and they are illegal in the United States, which means legal. We don't issue them anymore, but some foreign countries do, again, because they are an interesting investment, and it's very liquid investment as well. So there you go, a little movie trivia, but that's what a bearer bond is. The bearer of the bond receives it, and there's no identification needed. So, the dollar appreciation of bond value. Investors may be able to sell those bonds at higher prices. Okay, so again, everything is bought and sold in the world, and for different reasons. Okay, and so if you have a bond that is paying at 6%, let's say you have that, and the general interest rate is at 3%, you get to sell that bond at a premium. So we're trying to find the market value of that. So that's the dollar amount of interest to the comparable interest rate. So you can buy and hold, and just keep that interest going throughout its maturity. Or if that bond becomes more valuable, you may be able to sell that pretty quickly. And bonds are traded all day long. So the yield, we've got a calculation right in here of what your yield rate is. And generally, if you have a $100 coupon payment and it's a $1,000 face value bond, your coupon rate is 10%, which would be amazing. The bond ladder, and this is what we're looking at right in here, the graphic behind here. You want bonds that mature at different times and at different interest rates. So you may have some very secure bonds, and maybe you have some bonds that, if we popped out here, could be in the junk bond category because they pay a higher interest rate, but you've got enough diversity in your bond ladder that makes a bigger interest rate, but it has more risk. So, again, when you're trying to get the approximate value, let's say you had a Bank of America bond that paid 5.5% interest rates on a face value of $1,000. until 2023. So you bought this several years ago. Basically, you got $55 of annual interest. Now, you're holding on to this bond at 5.5%, but other bonds are coming out at 6%. How is your bond? If you wanted to sell that today, could you get a higher price? Well, more than likely you could not, because this is a bigger interest rate and there is the interest you're getting paid. So this comes out to $917. That's pretty much the market value of that bond if you did not hold it until maturity. So you can see the interest rates, kind of an inverse relationship there. If interest rates are high and you have a low paying bond, your value is going down. If interest rates are low and you have a high paying interest rate bond that you took out years ago, then you could sell that for maybe $1,100 or $1,200 in the marketplace. So again, if this is interesting to you for the corporate bonds, the same thing in the stock market. You have full service brokerage firms discount. You can get things on your own internet account, discount brokerage firms, of course. And again, there are those commissions bought and sold throughout the financial world. Now there's government bonds. Okay, government needs money as well. How do you think our national debt is financed? It is financed through treasury bills and treasury bonds and government bonds. So the government basically says we will pay this back at this point in time. And we basically have a double to triple A Moody's rating. That's who rates the bonds, because the government, again, we just have the authority to print money and to borrow money. So there's the levels of interest, okay? There's the federal bonds that do not have state income tax, so you don't have to worry about that. There's state bonds and there's local bonds. And again, basically they are in $100 to $10,000 denominations. There's your T-bill. T-bill's $1,000 minimum. Generally speaking, T-bills are about 10 grand at face value. Different maturities, again, they're sold at a discount. And so when the maturity comes, so they may be sold at $750, and in this period of years, they'll mature up to $1,000. Same with a treasury note, $100 units. Again, they are in 2 to 10-year maturities. The interest is paid every 6 months, and that is you can literally go down to the bank and you have a coupon book and you can get whatever interest rate. Now the interest rates are very low. They're under around the 3% range, maybe even less than that. Of course, the famous U.S. Treasury bond is basically looks like this. It's issued of $100, and they're sold at discount. So you wouldn't pay the $100 up front. You would pay $50 for that bond, and in 30 years it matures up to $100, and you get those interest rates paid. Again, either direct deposited to you or from the bank that you get it from. You go in and you get your interest rate. And again, they are held into maturity. If you need your money now, you can go in and cash those in at the bank. So I may have mentioned this earlier in Unit 1. It's hard to remember. But check your grandparents' attic, okay? Check out the attics. If you live up north and they're in basements, if you have grandparents that are still alive, these were how we financed World War II. It's how we financed basically the country, and they may have some old bonds just hanging around. And so once they mature, there's no more interest. Years ago, that was not the case. I'm sorry, I should say decades ago, like in the 1970s, that it could keep earning interest even if it were maturity. But that's not the case anymore. So if you have any bonds and they are at maturity, they're not going to pay anything else. So make sure you either cash those in or deposit those into your accounts. But a lot of the grandparents love that, and sometimes I've had some students over the years that went to their grandparents and said, "Hey, have you checked the stuff in the attic?" And sure enough, there was quite a few bonds just in an envelope waiting to be deposited in. So there you go. You may get a little bit of good fortune there. You may have heard municipal bonds. Municipal bonds or munis, again, they are state or local government, such as cities, counties, schools. We, Tarrant County College, issued $1 billion worth of bonds last year. And thank you for voting for that, by the way. Keeps us employed, keeps us going. And again, basically, those are we had a brokerage company in New York City, of course, and they sold off those bonds, and they sell them in different times as well. Now, the municipal bonds are basically right in to where those can be tax free. That's the big thing of municipal bonds. And again, my friends, we're going to have to go back decades. In those 1980s, when a municipal bond paid 6% interest and it was tax free, those were wonderful investments. I'm not sure these things pay 1% on a because you don't have the taxes on there, so you don't get as big as a return. How do they pay them back? Well, a general obligation bond, and those are the ones that we do. Is basically we're a taxing entity at Tarrant County College, and so we can tax. We set up sinking funds to pay that back, and that was the promise that we would not have to raise our tuition or raise any taxes. That we had the money. We just wanted to get a lot of projects done faster than we were doing, and but we've got the revenue system ready to pay it back. Now, a city could basically raise their property taxes, raise the sales tax if they needed to. A revenue bond is paid from an income generating project that the fund is financing. The Texas Star Golf Course in Euless, Texas was built in the 1990s and issued revenue bonds in the early 90s. And all the revenue that comes in from the golf course basically went to pay those bonds off. And it was so successful that it paid it back, paid all the bonds. They were able to call the bonds back in after 10 years. Those are revenue bonds. And again, the interest from a municipal bond are tax-free, but you don't get a very gigantic interest rate right now. But again, when you're in different income brackets and you're looking for safe income and interest-free, tax-free income, there we go. We have the municipal bonds. There's our rating service right in here. AAA is the highest. I think there's a AAA plus. That means these are going to be honored. Gets a little sketchy. So if you're in right in here, I mean, I'm paying the least amount of interest. Now, real quickly, the state of Texas has a reserve fund that is ginormous. It is in, I don't know what it is today, but it's something 10 billion plus dollars. And the state of Texas, when we run into budget shortfalls, anything like that, and Tarrant County College has a very big reserve fund as well. And the question is, well, why don't we spend some of that because we're in a bad time and we need that? Here's why states and large government organizations that have these reserve funds, here's why they'll never touch it. Because it keeps them in this rating right in here, the AAA to AA categories, all of these. Because Moody says, hey, you know what? The state of Texas can issue bonds at the best, lowest interest rate because they will pay it back because they have so much money in reserves. They're not going to touch that, so they can always have that great rating. That's the reason being. Now, if you're investing in these bonds in here, in the B to B minus range, to the C range, well, you should get a better rate of return. And now we are getting into junk. Right in here, junk. That means these could easily be defaulting very quickly. In fact, D is the worst right in here. So whatever interest rate, it better be really high, and you have that ladder of different mixes. So there's that information for you. To recap that, if we recap, as we are on our investment stage here, we know that corporate stock is the heart of U.S. investments. We know that this high risk and high reward, and we know there's a lot of diligence in our research to succeed in this. Okay, we've just kind of hit the high points here. Please don't let this quick little lecture think that it's easy to do. It's not, but there's great reward for those who do their great research. Bonds are debt instruments that organizations use. Again, these are ways that we finance our operations. Bonds have to be paid back. Stock does not have to be paid back. Does not. And the bonds are interest income. We have the steady return. And again, we're trying as we're building our knowledge, we're trying to have diversification in our investment strategies, that we can diversify, get a portfolio of something. And again, we're going to need to invest in our 401ks, our individual retirement accounts. And so we're going to keep rolling on this, my friends, and we're going to look at something that can do all of the above. So I hope you've enjoyed these 2 lectures, and we're going to look at real estate next. Let's make it a great day.